Markets mixed today as stocks attempt to shake off a rough start to the year, but with a lot of optimism already baked into the markets, is it fair to ask if investors are overly confident for 2024? Let's bring in Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. So Emily, it is great to see you. Listen, it's been kind of a bumpy start to the year here, Emily. Do you think, listen, that's kind of expected after the rip we saw in Q4, or no, maybe this is the start of something more serious?
Yeah, I think it's to be expected. I mean, the last couple of months of 2023 was just unbelievable, the amount of multiple expansion that we saw, the exuberance that we saw during this Fed pivot party. So essentially starting in the November Fed meeting, we started to see the more dovish turn from the Fed, and that was confirmed in December with more cuts priced in or seen in the statement of economic projections for 2024, and markets just absolutely loved it. We saw rates coming down, risk assets rally, huge multiple expansion. I think there's some oversold conditions there that are likely to be digested coming into this year. So it's almost like we had the pivot party, and now it's kind of the hangover to the pivot party. Maybe we call it dry January. So just kind of a slower start here to the year after so much overindulgence to end 2023. Not that I can relate.
Emily, none of us can relate to that. Of course not. Emily, it's great to see you, by the way. Happy New Year to you.
You too.
It's been a while.
Happy New Year.
So how long does this hangover last? Does it last for all of dry January, so to speak? And when do we get sort of a better equilibrium in pricing and expectations?
Yeah, I mean, there's a few catalysts here along the way. Of course, tomorrow we've got the jobs report, so we'll look for further confirmation that the Fed can start to look at least cutting rates into the latter part of this year. We've got another CPI report, of course, coming out, so we'll want to see continued disinflation in the pipeline, and then, of course, earnings. You know, last year was unbelievable just to see that earnings didn't matter much. Even the macroeconomic data wasn't all that helpful. You look at the leading economic indicators, now negative for 17 months in a row. Earnings were flat in 2023 for the S&P 500, yet stock prices, of course, were up about 26% on the year. So fundamentals didn't matter quite as much. And I think last year, if it was sort of the year of multiple expansion, maybe this year is the year where earnings come back into focus, where we start to see, other kind of more fundamental drivers. Maybe it's looking at income, looking at dividends as playing a bigger role in portfolios rather than just what's going on with the Fed and rates.
And Emily, I'm also interested to get your take on valuation just after the rally that we've had. Does valuation still look attractive to you here at these levels?
I think valuations are tough. Look, we came into last year at about 16 and a half times forward earnings. We're trading at 19 times forward earnings right now. So we're kind of bumping up on that ceiling that we came up on over the summer last year. And it's just tough to see more multiple expansion from here. You've got to see that earnings growth driver kick into gear here. And we think it could happen. I think the challenge, though, is that analysts are now penciling in about 12% earnings growth for S&P 500 companies this year. And it's just tough to see where that double-digit growth comes from, considering the fact that we have less fiscal support now, we have a much higher cost of capital, and we still haven't contended with the lagged impact of Fed tightening and how that may impact the labor market. So I think 12% to us feels a little bit overly optimistic. We'd be looking for areas of the market which maybe aren't sporting lofty valuations, maybe looking at areas like healthcare, utilities, which are both trading at a discount to the market. I think you could see a rotation there into this year.
And Emily, you and I talked a lot about bonds last year. And finally, at the end of the year, we saw more of a bond rally, which you guys had been looking for. What does the direction look like for rates and prices as we go into 2024?
Yeah, Julie, you reminded me of that a few times, especially on days where bond yields were going higher last year. No, it's okay. But to your point, one of the things we talked about a lot is how important that income component is in fixed income. And, the fact that you can get 4 or 5+% owning a high quality bond, even if there were to be some volatility in rates, we still love that income component. And that continues to be the case for us this year. We do see bond yields moving low. Of course, the move we just had was massive. So maybe we're in for a period here of sort of sideways choppy action as far as the rate environment goes. Again, we see signs of disinflation coming down. There always is a risk that inflation maybe picks up given how loose financial conditions are. We'll figure out later if Chair Powell meant for that to happen or not. It'll probably be one for the history book. So if we do see a reacceleration in growth, maybe that causes some chop in yields here. But traditionally what happens is that bond yields fall as you head into an economic contraction. We think that same playbook happens ultimately this time, which is why we see fixed income is continuing to do some more heavy lifting in portfolios in 2024.
And Emily, we did a whole interview here. We almost didn't mention the election, but we are in an election year. So I'm just interested, just as a strategist, Emily, how are you thinking about that?
Yeah, trying to use politics as an input into making investment decisions is kind of one of the most challenging things to do. And we've had a hard time doing it over the years. We found that business fundamentals matter a lot more, valuations matter a lot more, the macroeconomic cycle matters a lot more. And if you kind of look at the last 8 years of market returns, it's actually pretty remarkable to look. One would have potentially bet that areas like China would have suffered under the Trump administration. Technology stocks, that administration was relatively tough on tech. Those are the best two performing sectors. You'd think coming into the Biden administration, maybe that energy stocks wouldn't do as well given green energy policies. Maybe financials would take a hit due to some measures around regulation there. Two best performing sectors. So trying to use politics is just fraught with risk here. We would focus more on what's happening with the economy and what fundamentals are telling us.
And Emily, finally, we've been asking folks this first trading week of the year about sort of New Year's resolutions for investors. Anything that you are sort of thinking through either for yourself and your own strategy or that you would offer to investors on that front?
Yeah, sure. So obviously drink more water. That's always everybody's New Year's resolution, right? But I think, for investors, I think it's a great time right now to do a little bit of a gut check. We just saw incredible returns. You're seeing a lot of momentum around, allocating to riskier parts of the market. We just saw one of the biggest moves in areas like unprofitable companies and small cap stocks. It's really easy to kind of get caught up in the excitement of reaching for risk here. And it's not that we don't want to participate. We do. We just want to be really mindful of mitigating risk by looking to higher quality and more defensive areas of the market this year.
Emily Roland, pleasure to see you. Thanks so much for being here. John Hancock Investment Management Co-CIO. Thank you.